Hello everyone, and welcome back to another episode of Simply Wall Street's Market Insights. My name's Michael, and this week we'll be discussing the winners and losers from the Genius Act. Yep, that's really what it's called. It stands for the Guiding and Establishing National Innovation for US Stablecoins Act of 2025, and it could change the stablecoin landscape forever. When you hear stablecoins, just think digital dollars on a blockchain. Whether you're a crypto newbie or a battle-hardened market veteran, it's worth knowing about the consequences of this development. If it gets through the Republican-led House and to the president's desk, it will get signed into federal law. So this week, we're unpacking what stablecoins are, why Washington cares so much about them, and who the big winners and losers might be. Most importantly, we'll connect the dots to the investment decisions, from the stocks that could benefit to the risks you should watch. If you'd like to read the full piece, which goes into a lot more detail, you can find the link to that article in the description. Now, before we dive into stablecoins and digital dollars, let's hit the headlines. If you don't want to hear what happened in markets last week, just use the chapters below to skip ahead to the main piece. Now, here's what shook markets. First up, Jeff Bezos is trying to cash in on the Trump-Musk fallout. With SpaceX dominating NASA and military contracts, Blue Origin is positioning itself to scoop up business, thanks to some well-timed political networking. Bezos is pitching Blue Origin as a dependable alternative, with reports of high-level meetings, PR campaigns, and even a White House wedding photo op. If the charm offensive lands, expect big shifts in lunar and Mars mission contracts, but only if Blue Origin can match SpaceX's speed and reliability. Next, the Fed is floating a plan to ease capital requirements for big banks. The proposal would reduce the Enhanced Supplementary Leverage Ratio, also known as ESLR, from 5 to 6% to around 3.5 to 4.5%, potentially unlocking over $200 billion in balance sheet capacity. That could support liquidity in the Treasury market and help during financial stress. But critics argue it increases systemic risk by shrinking banks' capital cushions. It's a classic trade-off between market functionality and financial resilience. Then there's a new chapter in the chip war. The US is considering revoking waivers that allow Samsung, SK Hynix, and TSMC to send US chip-making gear to their Chinese plants. That could spark disruptions in global chip supply chains and strain ties with key allies like South Korea and Taiwan. Watch out for supply bottlenecks, rising costs, and defensive plays from chip firms if this goes ahead. Over in Arizona, SoftBank's Masayoshi Son is dreaming big. He's pitching a $1 trillion AI and robotics hub called Project Crystal Land. Think of it as America's answer to Shenzhen, centralizing AI and robotic manufacturing in the desert. He's courting everyone from TSMC and Samsung to Trump himself. If it takes off, we could see huge momentum in AI infrastructure and US-based chip making. Nvidia is also stirring things up. It's diving deeper into cloud computing with DJX Cloud and fresh investments in AI-focused cloud players like CoreWeave. With control of 80% of the AI chip market and nearly $11 billion in multi-year deals, Nvidia's cloud ambitions could eat into profits at Amazon, Google, and Microsoft. Keep an eye on how quickly DJX Cloud scales and whether rivals counter with their own AI chip offerings. And finally, Nike's sounding the tariff alarm. They expect a $1 billion hit in financial year 2026 due to new tariffs, which has prompted a strategy shift from the company. They're cutting back on China sourcing, now down to 16%, and doubling down on wholesale channels and innovation under their new CEO, Elliott Hill. The company is adapting, but investors should watch for signs of margin pressure and resilience in North America. Alright, now let's talk stablecoins. At its core, a stablecoin is a digital token pegged one-to-one to a fiat currency, usually the US dollar. Think of it as a blockchain-powered IOU for a dollar. Reputable issuers like Tether and Circle hold real assets, like US Treasuries and cash, for every token they issue. Together, those two hold about $166 billion in treasuries. So why is there so much demand for stablecoins? Well, stablecoins offer the reliability of the dollar paired with the efficiency of crypto. You can send money globally, instantly at low cost, 24/7. In high inflation countries, stablecoins are used to store value. As for cross-border commerce and remittances, they're a game changer. And they're growing fast. Deutsche Bank says stablecoin transaction volume hit $28 trillion last year, which is more than Visa and MasterCard's networks combined. Big names like Amazon and Walmart are exploring their own coins, and PayPal's already rolled out PYUSD. That's why the Genius Act matters. It brings regulatory clarity to a fast-growing space. And here's the specifics of what the Act does. Firstly, only approved issuers, i.e. regulated banks or firms with a special license, can issue payment stablecoins. Each coin must be backed one-to-one with cash or short-term treasuries. That means no algorithmic backing and no crypto as collateral schemes. Also, issuers must publish audited monthly reserve reports, and senior execs have to sign off under legal liability. Stablecoins can't offer interest payments, so they don't compete with bank deposits. That's a concession to protect banks' funding base. Additionally, there's a dual oversight model. Big issuers, those over $10 billion worth, fall under federal regulation, and smaller ones can be regulated by states that meet minimum standards. And as for unlicensed issuance of stablecoins, that's now illegal, with penalties and fines up to $100,000 per day. This regulatory clarity is a green light for institutional players. Circle, for example, had already performed incredibly well before the bill had even passed. After the bill passed on June 17th, it climbed even higher. So who's winning in this new stablecoin era? Well, Circle and Tether stand out. As trusted, heavily compliant issuers, they're poised to dominate, although Circle is more compliant than Tether considering it's based in the US. Circle co-founded USDC with Coinbase and is evolving into a major fintech player. Tether, despite less transparency, earned $14 billion in profits last year with only 150 employees. Fintechs and exchanges like Coinbase, PayPal, and Fiserv stand to benefit as well. Stablecoins fuel transaction volume and fee revenue. Fiserv's stock jumped after its partnership with Circle and PayPal was announced. Big tech firms, from Meta to Uber, see efficiency gains via stablecoin payouts. And the US government, they benefit from stablecoin issuers becoming major treasury buyers. Tether already holds more US debt than several countries. This strengthens the dollar's global dominance, and Congress knows that. But not everyone's cheering. Remittance giants like Western Union and MoneyGram are facing a serious threat. With near-instant, ultra-low-cost transfers enabled by stablecoins, their traditional business models are under threat. Western Union's app downloads are already down 22%. Unless these firms adopt stablecoin infrastructure quickly, shrinking market share and tighter margins are almost inevitable. As for banks, especially smaller regional ones, they aren't immune either. Even without offering interest payments, stablecoins may siphon away deposits thanks to their sheer utility and convenience. That could pressure these banks to increase rates to retain customers or find new ways to stay relevant. The larger banks can probably adapt, but smaller players might feel the squeeze. Then there's the long-term wildcard for card networks like Visa and MasterCard. While they have been hedging their bets by partnering with crypto firms, they could still face pressure if stablecoins start replacing their rails, especially for peer-to-peer and business-to-business transactions. With 2 to 3% interchange fees on the line, there's a real risk that revenue gets cannibalized unless they evolve fast. Before we get to the takeaway for investors, there's one more group worth mentioning. Other countries that have been slow to regulate stablecoins could find themselves at a disadvantage. If their citizens begin adopting US-backed stablecoins over local currencies, it weakens the influence of their domestic monetary policy, what some are calling digital dollarization. This could strip central banks of control unless they respond by being more fiscally responsible, i.e. less money printing, more transparency, and policies that actually encourage people to want to hold the local currency. Now, what's the key takeaway for us investors? New catalysts require updated narratives. The Genius Act is a turning point. It rewrites the rules for a growing part of finance. That means investors need to revisit their narratives because what was true 3 months ago might no longer hold. If you hold a stock in a company like Circle, Coinbase, or Fiserv, it's probably fair to assume that their revenue potential has gone up. More adoption, more fees, more legitimacy. But if you're holding incumbents like Western Union that are slow to adapt, it's time to reassess. Revenue and margins could shrink, and PE multiples may follow. If you're invested in multinationals or businesses that pay steep processing fees, if they switch to stablecoins, this could improve their margins. But if a company profits from legacy rails, that margin cushion may evaporate. So what can you do? Well, on Simply Wall Street, you can use our narrative templates to map out how this legislation affects any stock you own. Ask yourself questions like, will this bill increase or decrease this company's revenue and margins? Are they positioned to benefit or be disrupted? It's a great way to update your thesis and then compare your notes with other investors in the community. And that's where we'll wrap up this week's Market Insights. If you'd like to read further insights on this piece, just check out the article which will be linked to in the description. As always, if you have any feedback, please do let us know. We'll be back next week with more Market Insights, but until then, invest well.